Welcome to vTalkInsight, Market Drivers Daily for December 3, 2025. AI spending, shifting geopolitical fault lines, and a re-accelerating growth narrative are colliding right now, and markets are trying to price what is durable versus what is hype. Let's start with how the AI build-out is reshaping macro, credit, and equity leadership. Across assets, the center of gravity is still AI, but the story is shifting from pure excitement to hard questions about sustainability, competition, and balance sheet risk. New numbers suggest AI investment is already adding to U.S. growth at roughly 3 times its historical pace, and AI-driven capital expenditure has now overtaken consumer spending as the main driver of expected U.S. GDP growth in the coming year. That is a big change from the consumer-led narrative we discussed recently, and it helps explain why some houses still see room for new highs in U.S. equities despite fragile risk sentiment. On the ground, the infrastructure build-out remains intense. AWS is committing to an annual upgrade cycle for its Trainium AI chips, and already more than half of all tokens and inference on its Bedrock platform run on second-generation Trainium servers. At the same time, AWS plans to double its data center capacity to 8 gigawatts by 2027 and is deepening partnerships with both NVIDIA and Anthropic, positioning itself as a preferred platform when clients move from proofs of concept to production AI workloads. Strong demand is not limited to the hyperscalers themselves. NVIDIA's finance team reports orders for GPUs are still accelerating, while data center connectivity and optical names like Credo Technology are posting revenue growth above 270% as cloud providers race to upgrade networks. These investment flows are feeding into earnings in a more distributed way than a few months ago. Results from software and infrastructure suppliers show this clearly, with MongoDB, for example, lifting its outlook and seeing a sharp share price reaction after attributing strength to AI-powered applications. More broadly, the earnings gap between the largest U.S. tech names and the rest of the S&P is narrowing, and analysts increasingly expect AI-driven productivity gains to support margin expansion for U.S. industrial and enterprise companies over several years. That potential margin story is one reason some equity strategists still favor U.S. stocks, arguing that robust earnings and ongoing AI Capex can sustain growth even if the labor market cools modestly. Valuation is where the narrative becomes more nuanced. Flagship AI enablers such as NVIDIA are trading on forward earnings multiples in the low to mid-20s, which does not scream bubble on simple metrics, yet overall AI valuations are elevated and increasingly sensitive to competitive dynamics. Competition is intensifying on several fronts. Google's Gemini launch is pressuring OpenAI, which has seen user growth slow even as it projects revenue climbing from around $10 billion this year toward $30 billion by 2027. While Chinese groups like DeepSeek claim their open-source models are approaching GPT-5 level performance on key reasoning benchmarks. Chinese models are now estimated to be only about 10 to 11% behind leading U.S. systems despite export restrictions on high-end chips, and China is rolling out AI nationally using domestic semiconductors and open-source software, the costs of which are being shouldered largely by shareholders of firms such as Alibaba and Baidu through lower cloud profitability. The scale of spending raises clear questions for credit and systemic risk. Estimates for the upcoming wave of AI-driven data center and infrastructure investment range from about $5 to $7 trillion over 5 to 7 years, with some forecasts putting cumulative AI infrastructure spending closer to $8 trillion by decade's end, even though current business fundamentals do not fully justify that level of capex. A sizable share of this is being financed through debt. Private credit exposure to AI-related projects is significant, and investment-grade markets are expected to see major technology firms like Meta, Amazon, and Microsoft become among the largest issuers as they fund data center expansion. There is also concern about circular financing structures, where AI companies reinvest back into their own investors, amplifying upside but potentially exacerbating any downturn if sentiment cracks, a risk that is drawing the attention of regulators such as the Bank of England, which is launching a private market stress test with explicit focus on AI-linked assets. Even if the capex is funded, the build-out is not frictionless. Rapid growth in AI infrastructure is generating persistent bottlenecks in chips, power, and data center components, and the constraints keep moving as each part of the supply chain tries to catch up with demand. That feeds into a more complex inflation picture. Prices paid for the physical materials needed for these projects and weak traditional manufacturing data point to pockets of stagflation pressure, even as AI adoption is expected to create near-term disinflation and possibly deflationary shocks in 2026 through higher productivity and labor market disruption. At the same time, non-economic risks are becoming clearer, from misinformation risks as large language models generate plausible but incorrect content, to rising data costs for information sources like Wikipedia that are exploring ways to make AI users pay for access. Markets are reacting in mixed fashion to this evolving backdrop. Some asset managers maintain a clearly pro-risk stance, arguing the sheer scale of AI-related spending is now shaping macro conditions and supports a constructive view on risk assets, while others, including several UK pension schemes, are trimming US equity exposure on concerns about an AI-driven bubble and heavy index concentration. Within equities, there is growing focus on a potential rotation from pure AI enablers toward companies with strong balance sheets and cash flow that effectively adopt AI, especially in sectors like healthcare technology and software where secular disruption could be particularly acute. For now, the key watch points are whether AI revenues and new business models can catch up with the pace of Capex, how quickly Chinese competitors continue to narrow the performance gap, and whether credit markets continue to absorb AI funding needs smoothly. Those answers will also shape how much room geopolitics has to shock the current narrative. Turning to geopolitics, the most immediate flashpoint for European assets remains Ukraine, where the search for a durable peace deal is still stuck. Negotiations are effectively deadlocked, with Ukraine unwilling to concede territory and Russia demanding full control of Donbas, and recent efforts by the US, including pressure from the Trump administration to accelerate a deal, have drawn criticism because Ukraine has at times been excluded from key discussions. European officials are increasingly vocal about the risk that any settlement reached without their input could force Kyiv into disproportionate concessions and leave Europe carrying a larger long-term financial and security burden. In practice, there is broad European agreement that, whatever the outcome of talks, deterrence and capability building have to continue, which is reflected in Germany's plan to approve roughly €2.9 billion in military procurement contracts and a coordinated push with NATO to modernize defenses. Defense spending is one area where geopolitics is clearly feeding into growth and sector positioning. European strategies are tilting toward AI-enabled and autonomous systems for border security and surveillance, and Germany is working on AI platforms for NATO's eastern flank, but there are significant integration challenges as these new technologies are grafted onto legacy hardware and slow-moving institutional processes. Scaling production will likely require tapping the broader industrial base, including the automotive sector, since current defense employment alone cannot deliver the volume of advanced systems policymakers want. Market pricing reflects this unease. European defense stocks are seeing mild gains and heightened volatility rather than a straight-line rally, and Central and Eastern European currencies are flagged as key sentiment barometers that could see larger swings if peace negotiations surprise in either direction. The war is also being waged through energy. Ukraine is deliberately targeting Russian energy infrastructure, including refineries and the so-called shadow fleet of tankers that move crude outside formal channels, and recent attacks on vessels in the Black Sea and near Seagal underscore the vulnerability of Russia's export routes. Despite this, oil markets are not especially tight at the moment. Ample supply expectations and the ongoing rebuild of the U.S. Strategic Petroleum Reserve have kept prices broadly range-bound. That helps explain why markets continue to fade most geopolitical headlines unless they have a direct read-through to oil or company earnings, although a sustained disruption to Russian export volumes would likely change that calculus quickly. Beyond the battlefield, competition for natural resources is intensifying. The European Union plans to invest at least €3 billion over the next year to reduce reliance on Chinese raw materials, and is preparing a broader strategy to diversify critical inputs for industries such as defense and advanced manufacturing. Yet U.S. companies are moving faster and locking down supplies of rare earths and other key materials, leveraging stronger balance sheets and capital markets, which raises questions about Europe's ability to secure what it needs as AI and defense spending rise. Latin America sits at the center of this contest. China has already become the primary trading partner for most South American countries, and the global AI revolution is lifting demand for the region's natural resources, enhancing its leverage with both Washington and Beijing. In East Asia, geopolitical risk is simmering rather than exploding, but the time horizon is long. Taiwanese officials expect diplomatic tensions between China and Japan to persist for up to a year, and almost half of Chinese flights to Japan this month have been cancelled, hitting tourism-dependent cities such as Sapporo and Osaka. At the same time, Japan is aligning more closely with Taiwan on security, even as Taipei deliberately downplays tensions with Beijing to avoid escalation, and the absence of Taiwan from recent US-China communications has reduced immediate friction but left uncertainty about longer-term commitments. All of this sits against a backdrop of a fragmenting global technology landscape, with China and the US building separate supply chains and digital ecosystems and the UK edging toward a more pro-business stance with China while still stressing security, a mix that primarily affects markets through trade, tourism, and supply chain-sensitive sectors rather than broad-risk assets. Stepping back, the consistent pattern is that markets largely shrug off geopolitical noise unless it hits earnings through channels like oil prices, key input costs, or regional currencies. That is visible today in the combination of range-bound crude, choppy but not disorderly European defense stocks, and selective volatility in Central and Eastern European FX and in assets tied to countries such as Russia and Venezuela. The watch list from here includes any breakthrough or breakdown in Ukraine negotiations, particularly if it changes the path of European defense spending, a shift in the tempo of attacks on Russian energy infrastructure that might alter oil balances, and any escalation in East Asia that starts to disrupt travel flows or technology supply chains. For now, though, geopolitics is more of a background risk premium than the main driver of asset prices, leaving room for growth dynamics to dominate the narrative. Growth expectations are gradually tilting from a pure consumer story toward an investment-led mix, with AI at the core. AI investment is already contributing to U.S. economic growth at around 3 times its historical rate, and AI-driven capital expenditure is now seen as the primary engine of U.S. GDP growth in 2025, even as traditional indicators like manufacturing surveys remain soft. Some global managers link this to a positive equity outlook, arguing that persistent liquidity, solid corporate earnings, and AI Capex together can support new highs in U.S. stock indices, provided that any cooling in the labor market stays orderly. The consumer backdrop still matters, and the latest signals are generally constructive. Holiday retail metrics have beaten expectations, and the National Retail Federation projects that this season's U.S. holiday sales will exceed $1 trillion for the first time, with growth in the 3.7 to 4.2% range driven mainly by real volume rather than inflation. Buy now, pay later usage is surging, with one forecast pointing to more than $20 billion in holiday purchases via these plans, up about 11% year-on-year, and travel spending remains robust, with so-called Travel Deal Tuesday expected to generate several times more bookings than Black Friday and Cyber Monday combined as households prioritize discounted trips. Autos are another bright spot. U.S. light vehicle sales are on track for an annualized rate around 16 million, led by traditional segments such as pickups and trucks from manufacturers like GM, Ford, and Stellantis, while electric vehicle demand looks softer near term. Labor and cyclicals are where the medium-term growth call becomes more finely balanced. The headline view is that the labor market remains broadly stable, with only a slight uptick in unemployment and optimism that hiring will strengthen into 2026 as GDP and earnings growth hold up. Forward-looking indicators, including interest rates, oil prices, money supply, and the yield curve, are cited as pointing toward a return to expansion in manufacturing and other cyclical sectors by 2026, helped by expected fiscal support, even though recent ISM data show 9 consecutive months of contraction driven by trade policy uncertainty and weak demand. For specific industries, such as U.S. airlines, earnings are taking a transitory hit from operational disruptions in the fourth quarter, but the sector-level outlook is still framed as positive if the macro environment continues to improve, with United Airlines highlighted as a key growth story into 2026 thanks to fleet renewal and cost management. Outside the U.S., there are signs that growth momentum could broaden. In Europe, stronger household wealth and potential fiscal stimulus are expected to bring a faster recovery than current consensus, with some strategists projecting euro area equities can deliver mid-single-digit price gains and low single-digit dividend yields next year after a flat earnings period. European financials are overweighted in some allocations on the view that greater AI integration will both disrupt and energize the sector, even though Europe has a smaller listed technology universe than the US. Latin America stands to benefit from its resource endowment and proximity to the US, as the AI revolution lifts demand for commodities and supply chain diversification increases its bargaining power, while in digital assets, the SEC is preparing an innovation exemption for crypto activities, and infrastructure providers like Chainlink are seen as central to tokenizing traditional assets, a market that some expect could grow from roughly $30 billion today to the trillions over the coming decade. There are, however, meaningful risks around this constructive growth picture. Near-term U.S. labor data could disappoint, even as planned fiscal stimulus and tax rebates are expected to drive a reacceleration in growth and inflation next year, and some forecasters see 2026 characterized by deflationary shocks linked in part to AI, with a possibility of returning to a more balanced, so-called Goldilocks environment thereafter. At the sector level, there is a potential mismatch between rising inflation and the physical materials needed for infrastructure buildouts and the longer-term disinflationary effects of AI, which could result in pockets of stagflation even as headline price pressures moderate. Financial conditions also matter. Volatility in cryptocurrencies and AI-related equities has already made investors more cautious. AI infrastructure investment is projected to reach up to $1 trillion or more by the end of the decade without current revenues fully supporting that scale, and a sizable chunk of private credit is tied to AI projects, which could prove problematic if returns fail to materialize. Putting it together, the growth narrative is gradually rotating toward investment and productivity as the key engines, with consumers, travel, autos, and selective fiscal support acting as stabilizers rather than sole drivers. The implications cut across asset classes, from a potential broadening of equity earnings beyond mega-cap tech, to increased investment-grade issuance by large technology firms, to a deeper intertwining of digital assets and traditional markets through tokenization. Key watch points include how quickly AI Capex translates into measurable productivity gains, the trajectory of labor market data into 2026, the scale and timing of fiscal packages in the US and Europe, and whether manufacturing and other cyclicals start to confirm the upbeat signals coming from forward indicators. Those outcomes will determine whether today's mix of AI enthusiasm, geopolitical risk premia, and growth optimism resolves into a sustained expansion or a more volatile, stop-start cycle. Across AI, geopolitics, and growth, the common thread is that capital is moving aggressively into technology and security, while markets are still debating how much of that spending will ultimately be justified by earnings and productivity. The balance between elevated AI Capex, contained but persistent geopolitical risk premia, and a gradually more investment-led global growth mix will likely define cross-asset performance into 2026. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.